a pleasure to have you guys here again. As you know, my name is Juan Escano. I'm Chief Risk Officer at Seahorse. I'm here today with Daniel Clark as well, a familiar face on all of our webinars and podcasts. And Mr. Isaac Correa, who's our ESG expert. Today we'll be recording the second webinar in our 4-part series. This webinar is about sustainable futures in finance, scenarios, and megatrends. So Isaac, you have the floor.
Great, thank you very much, Juan and Daniel. Let me just share my screen so that you can pretty much be looking at the presentation over here. Could you please tell me if you already see the presentation?
Got it.
Excellent. So welcome everyone to this second webinar about sustainable futures in finance. Particularly, we'll be looking a little bit deeper into how to use scenario analysis and how to take advantage of the different mega trends on the ESG side. And in order to do this, we are going to be looking first of all at what, let's say, timeframes and futures mean for ESG. Afterwards, we're going to be taking a little bit in-depth conversation in terms of what are the mega trends that may be arising for 2023. And finally, how to apply this into your own ESG strategy. So beginning this conversation, we have to remember that sustainable development, and particularly ESG, is very much linked to the way that we understand sustainability and sustainable development themselves. And within the core definition of sustainable development, there is this notion about the future. In our common future, particularly, we define sustainable development as the development that meets the needs of the present without compromising the ability of future generations to meet their own needs. So this means that we have to be looking at future generations, right? But this usually tends to be something that we overlook, or that we think that somebody else is going to be responsible for figuring out what to do afterwards, and or whatever impact we might have in the present. So basically, what I want to point out here is to highlight two things. The first one is that sustainability and ESG by itself inherently needs to consider futures themselves, and that it is considered that future is built from collective action, meaning that it is not that there is some future written already over there, but that we actually have the ability to have a vision about the future and collectively figure out how to make this reality and the present conditions move towards that collective vision that we have about the future. So having this in mind, the question that we will be exploring within the webinar is how to apply these futures into the organizational strategy and how to use them particularly for this ESG in this long-term vision. So as a context, we have different future timeframes that are widely accepted in order to talk about ESG and sustainability. Both of them were pretty much decided or agreed upon by the international community around 2015. And the first one is going to be talking about the Sustainable Development Goals. So let's remember that whenever we talk about ESG, we have three main dimensions, right? So we have the environmental, the social, and the governance dimension. So whenever we are talking about the sustainable development and ESG, we have to understand that the belief or the assumption is that these three dimensions have to exist and have to be collaborating in order for us to actually reach this sustainable development, and that there cannot be, let's say, a value created exclusively on one of these dimensions, but rather this kind of joint value that is going to be created on the three dimensions, right? So within the Sustainable Development Goals, there are 17 goals that were set in these three main dimensions, and each of these goals was having a specific set of targets that would have to be met in order for us to actually say that we are reaching these goals, right? And one of the main innovations about this new set of sustainable development goals, replacing the Millennium Goals, was that this does not only pertain the role of government, or portray the government as having the sole responsibility of achieving this. But actually, they're much more collaborative in terms of understanding that governments alone cannot reach sustainable development, but they need the society at a wider range, and also companies and also the private sector to be joining into this particular achievement. Okay, and these sustainable development goals have the time frame of 2030 in order for us to pretty much be doing this last evaluation of the sustainable development goals, and cover a wider range of topics. The second time frame that is quite relevant when talking about ESG is particularly regarding the Paris Climate Agreement, and especially there are two let's say issues that arise from this Paris Agreement. The first one is um, it has the objective of trying to reach net zero or decarbonization of the economy, as it recognizes that climate change, for example, even though it's a mainly environmental well, let's say issue, it can also have different points that might affect other areas, for example, economic development, for example, social welfare. And climate change therefore has a wider and a range of impacts that do not only let's say limit themselves to the environmental realm. Okay, so within the Paris Agreement, we are talking about two distinctive timeframes. The first one is we should be achieving a net zero by 2050. That means that we should get this carbon neutrality in terms of how much emissions we are putting into the atmosphere due to industrialization and industrial activity, and climate resilience, meaning that we should be able to face the futures and the impacts that are considered inevitable right away in terms of climate change. And by 2030, we should actually also have another, let's say, relevant reduction, and that would be in terms of having a 50% reduction of the absolute emissions that we have, well, that we had as a baseline considering 2015. Okay, so as we're seeing, these timeframes are, let's say, internationally accepted, but they also require that organizations have these, let's say, foresight capabilities, and that we also, let's say, achieve a way of flexibility in order for having our strategies trying to meet these different goals and trying to collaborate towards this common vision. I don't know if until this point there is any question.
I do have, I would like to get your perspective, Isaac, on one thing. I love the goals and how they're laid out on your slide. It's great. It makes it really easy for me to see what's going on. The thing that jumps into my mind real quickly is that a lot of this is going to depend on a lot of different people and ultimately on governments across the world to support. Is there something from your perspective and your experience, is there something that we as individuals can be doing within our companies or within our own countries to help bridge the gap that I see between governments and what they want to do and the rest of us who want to meet these goals? How do we deal with that? Because I think that might be the hardest challenge or the strongest challenge out there for us.
Absolutely. So that is actually a great question, because whenever we are pretty much talking about this possibility of achieving the goals, it seems like very far from our everyday lives or the ways that we operate, or that we might be doing something as individuals, right? Um, the innovation that we are seeing in this in this Sustainable Development Goals for 2030 agenda is that it is a matter not only of us as individuals, for example, but there is this possibility of collaboration. So, in terms of, for example, companies or these individual actions, it is pretty much designed, or this framework is designed so that we, first identify how to do this kind of transition towards more sustainable economies, and in which way can we also join as individuals or as, let's say, this broader society, right? So, for example, from the perspective of a company, there is also this perception or this new, let's say, discussion about just transition, meaning that not everyone has the same responsibility, and you're not going to pin the same kind of responsibility, for example, by industrial sector, meaning, I don't know, the transition that or the responsibility that some developed countries may have versus some countries that are developing still, or the oil and gas sector or the construction material sector, respectively, rather than the services sector or something that may be having less impact. So assigning these responsibilities is one of the biggest talks that has occurred right away. But we have also seen great examples of how these collective actions of different companies may be leading to achieving some of these sustainable development goals. So I don't know if I helped you with that question.
Yeah, you did. That's very helpful. I guess it jumps to two things that I got from that. One is that there is progress being made presently in a lot of these areas, and that people are focused on that. And the other is that we as individuals can't get overly concerned about everything because we don't have that capacity. So we need to look at what
Yeah.
we're doing and focus on the things that we can focus on. That's kind of the message I got from that. So I appreciate that. That's a great answer. Thank you.
Thank you so much. That is actually great, and those are the key takeaways from this slide and from this discussion. Thank you so much. So, if we're talking about these timeframes, it is also very important to try to figure out what do we mean by these futures, and how to use these let's say, forecasting capabilities in order for us to build resilient strategies and build strategies that may also having a positive impact from the ESG perspective, right? So I'm going to dive into two definitions. The first one is this funnel about the futures, where we can see in this graph, for example, where we are now and how we're moving into the future, and the amount of uncertainty that is going to be, let's say, we are going to be experiencing is going to be increasing towards we move to the future, right? And there is also this other axis that is going to be pretty much talking about the potential for change, meaning that although there are social, economic, or even different structures that may be having an influence on the impact that we have from an ESG perspective, this potential for change is going to be greater as we move into the future. But there's also an uncertainty of how much are we going to be doing towards this future, or are we going to be able to do towards this future, right? So this actually tries to figure out which are the possible futures that we can be talking about, right? And this red line over here means business as usual, meaning that there is no change. And this, let's imagine an imaginary zero over here. So there is no change in the conditions that we are experiencing. Then there's going to be this orange circle over here that is going to be talking about the plausible futures, meaning let's say from the futures that exist over there, which ones have some kind of probability of existing. And it is going to be even, let's say, a smaller circle in terms of which are the probable circles, meaning that out of the different variables that might be influencing the way that we see these futures, there is going to be some variables that we believe that are going to be core in order for us to achieve these kind of changes. And assigning that probability is going to lead us to understand up to which point can we actually change. Okay, and from these different circles, there's, for example, these also possible futures, but we are not looking at any kind of probability, for example, or not doing any kind of assessment about the capability that we have to reach those futures within this funnel. And finally, there's going to be another circle that is going to be the preferable the preferable futures. So whenever we talk about, for example, these goals or this let's say probability of achieving these goals and so on, there is going to be an overlap about the probable, well, between the probable and the preferable futures. That is the way that we should be aiming to do that. Okay. A big question over here is, well, then how possible is it to reach this kind of preferable futures? Well, in terms of possibility, it is possible. It is hard sometimes because it means that we have to deal with a lot of uncertainty, with a lot of complexity within our organizations, or the way that our organizations interact with the environment and so on. But it doesn't mean that it is impossible to change this kind of future, right? So from this, we are actually moving to which capabilities should we be building in our organizations in order to try to move towards these preferable futures within the capabilities that we have, right? So one of the things is usually we tend to see just this kind of predictions from forecasting planning, okay? And this means that we are focusing only on one of the variables and trying to figure out how is it going to move or how is it going to behave towards the future, and how much, for example, is this going to be, let's say, diverging from the established path that we have right away. And the big change that I want us to see over here is not just building the capabilities, for example, in terms of data to forecast something, but actually to try to foresight something. And this means not only taking this capability to foresight, but also applying it towards different scenarios and building strategies that might be functional across these different scenarios. Okay, so what is the difference then? That in the prediction, we are pretty much assuming that all the conditions are going to remain the same, and therefore this forecast is going to use only or mostly historical trends. And in the foresight and scenario planning, we are aware of the uncertainties, and that we are aware of how these uncertainties may affect, for example, some of the outcomes in the future. And therefore, we build different scenarios so that we can, let's say, like frame this in a different way and think about different possibilities of, well, what if these uncertainties do happen or don't happen? Okay, and this actually makes for most resilient, let's say, ways of understanding these future capabilities. And therefore, as organizations, we should be building these capabilities to foresight based on different scenarios and based on an analytical profile that goes beyond one single variable. Okay. This leads to different archetypes of the future. We usually tend to see at least four possibilities. The continuation, that would be, let's say, just following this historical trend. And for example, in this example, if it goes upwards, then, well, following that particular trend. Limits and discipline, that is usually, let's say, an assumption when talking about ESG and sustainability, that pretty much assumes that everyone is going to do their fair share and limit the growth and take on their responsibilities and so on, and achieve this kind of discipline in terms of respecting certain planetary boundaries or certain social conditions that have to be, let's say, we're willing to see as a baseline for development and so on. Then there is a transformation, which is usually, let's say, very linked to technological innovations and so on, where not only are we, let's say, continuing this point in time or this historical trend, but we are unlocking different possibilities of development over here, or having a different impact that might be greater or at least distinct to what we have historically seen. And finally, decline and collapse, which usually has, let's say, this kind of pessimistic view about the future, where it is not possible, for example, to maintain a certain level of economic development or social development or environmental, let's say, ways of using this biodiversity or resources or whatever, and then the system collapses at a particular point, and leading all of the surrounding systems around it. Okay, so these archetypes of the future usually helps us to build the previous scenarios that I was mentioning. So if we haven't identified which are the uncertainties that are going to lead, let's say, the way, or that are most relevant for a specific scenario planning exercise, we can base our first scenarios on these archetypes. So what happens if it keeps the same way? What happens if it transforms different, and how would that be seen? Okay, and this is also a conversation that we should be having in terms not only, for example, of our own organizations, but also in terms of the industry that we may be participating in.
Isaac.
So yes.
Excuse me, sorry for interrupting.
No.
I have a question.
Yeah.
I think regarding these archetypes, I was wondering, for example, does this model take into account any recent events or developments? I was just thinking about, for example, the recent breakthrough in nuclear fusion that was announced this week by the US. It seemed very exciting and promising, especially regarding the impacts it may have on climate change, right, as the topic of discussion today. So are these things adjusted in light of that, or how does it work?
Yes, that's a great example. Let's try to, let's say, put this into the context, or into into this framing of the archetypes of the future. We are standing here in this kind of great point, right? So if within these days we receive this information about fusion energy and so on, then and it continues, let's say, the path that we have, we know that this has been technology that has been researched over the last 60 or 70 years at least, right? So that means that the continuation, if we see, let's say, this trend of an exponential trend, that is usually the way that technology unravels, then we might find in the future some point over here, right? In terms, well, within between transformation and limits and discipline, right? But not only of the, let's say, adoption of nuclear and fusion energy, but also in terms of the use of energy, right? In this transformation, for example, what we're seeing currently in Europe, and with the disruption of the energy supply chains with Russia and Ukraine and so on, if we have this new technology, it usually, instead of, for example, keeping up this trend from the use of, I don't know, carbon-based energy, or even the traditional ways that we may find in terms of renewable energy and so on, then this is not going to be, let's say, the path that we are following, but actually it is going to be transformed. So we can use more energy, maybe in a greener way, and the historical consumption of energy is no longer dependent on, I don't know, natural gas, or whatever technology we're talking about. In limits and discipline, for example, in terms of this use or consumption of technology, this would mean that even though, for example, we have this breakthrough, it is not used yet, and this historical trend, we learn not only to adapt, let's say, these supply chains, but also to limit the way that we are using energy in the first place, and I don't know, through winter or through summer and so on and so forth, not keeping up this pace of growth of energy consumption. And in decline and collapse, meaning that it did not came around, let's say, soon enough, and actually we can no longer sustain, I don't know, the industrial production or the capability to provide energy to households in the same way, and it rapidly needs to be declining, or the system, let's say, of energy consumption collapses. So it is not looking just at one variable, but let's say trying to figure out which might be the different impacts, and which might be the possibilities towards a particular time frame in the future, let's say in 2030 or in 2050 and so on, and which might be the vision that we have about the future. And then once that we have these different scenarios and these different using the archetypes, or using different uncertainties, trying to establish which should be the let's say the possible strategies to cope with those impacts, and to cope with those results that we have over there.
I have a question for you, Isaac, too, and
Yeah.
I'm learning a lot, so we'll just stay here all day. I hope you don't have any plans for the next week.
Perfect.
One of the things that happens with boards of directors, they're very short-term thought of individuals. Earnings per share, what do we make this quarter? We got to make a profit this year, blah, blah, blah. Have you witnessed or heard of any success stories of companies or people that have changed that mindset, because a preferable future and a earnings per share sometimes are very conflictive? It might be nice if there's some examples of what we can do to help change the leadership perspective of, I've got to make X number of dollars this year versus I like to be around 5 years from now.
Absolutely. And it is a very interesting, let's say, it's a very interesting question, because what I'm about to say might not seem as the, let's say, most um, sustainable industry in the world. But actually, one of the companies that has not only, let's say, adapted these use of futures and scenarios, but also generated, let's say, new ways of thinking about the future within these kind of methodologies, is precisely Shell. So we do not usually think about the oil and gas sectors as being very, very sustainable. But what they have proven to do, or what they developed, was precisely, instead of doing this, let's say, traditional strategic thinking or strategic planning for the years, they usually have this kind of workshops about the possible futures, the possible scenarios, and so on, and what strategies can they actually, let's say, like build in order to face those possible futures, right? And actually, this comes to a very relevant issue, because for example, let's take the case of Shell. If you're seeing that most investors are divesting from I don't know, carbon intensive I don't know, assets, or if you see that there is a possibility, for example, within these different kinds of futures, that the oil and gas sector might be doing well right now, but in the future there might be several affectations, not only in terms of the environment, but also in terms of the transition and potential taxes, and a greater regulatory requirement from this sector. Then that means that if you're a company that is using that as a core issue, you're not only a company that I don't know, looks for new oil, but you are essentially a company that is trying to provide energy. So how can you open new business lines, and how can you open new ways of generating energy that, yes, may use, for example, the revenues that you're having right now in terms of oil and gas, but in the future maybe transforming the way that we think about energy, right? So I think that even though it's a very controversial sector, there is this, let's say, contribution in terms of how do we approach this kind of futures. And well, I think that would be an interesting case study.
Thank you. That's a great example. Really appreciate it.
Thank you so much. So for the next part of the webinar, I'll try to provide a general overview of these ESG megatrends. And just before we move to, let's say, this sign off of the last part of innovation and how to deal with futures, right? So we're going to be talking first of all about the mega trends that are pretty much provided for 2023 by two different, let's say, publications, or two of the most recent publications that we have. One is from Schroeder's, and the other one is from MSCI. And the first one refers to climate change and political will. So basically, what we're seeing over here is that climate change is not longer, let's say, a trend that is going to be phased out anytime soon. And instead of that, we see climate change as having this greater impact in the governance structures, in the way that companies can actually produce these commitments towards their shareholders and their different stakeholders in the long term. So we are seeing over here, for example, the way that different companies' boards have voted in terms of a climate plan and the implied temperature rise of their strategies. So this is very interesting to see because even though we have mentioned earlier this webinar that we should be pretty much aligned to a 1.5 degree scenarios, that would be the net zero that we talked about in the Paris Agreement. Uh, Most of the votes are still not reflecting that, or most of the plans that these companies, for example, have are still not well, reflecting that and that same relevance. So there is this kind of disconnect between, for example, the plans that companies have and the possibility to achieve them based on the votes that they have within their boards. And this is very relevant because this political will is not only, let's say, on the public side, but also can be reflected at this on this private level. Okay, and this is going to be linked to other, let's say, megatrend, that is the increase in regulation. A second megatrend is going to be natural capital and biodiversity. Actually, let's say, as 10 years ago, we were talking about climate change in the same way that we are talking about natural capital and biodiversity right now, in terms of understanding, for example, that the loss of diversity and the loss of natural capital is very much linked not only with the ability that we have to face climate change, but also in terms of social welfare, for example, or the need for some communities to move or to migrate because they do not longer have, for example, these capabilities to or this capital in terms of natural resources to build a good livelihood. And also the emissions that are associated with this, or that can be sequestrated from these natural areas, has been largely overlooked, right? So we're seeing this kind of trend to not only incorporate, let's say, these externalities that are that we are suffering from the loss of biodiversity and natural capital, but also to being able to consider which can be the specific impacts that this issue has on the revenues and the long-term success of companies. A third megatrend is precisely the cost of living and other social stresses. On the left side, we have this excess inflation that has, let's say, dominated the markets this recent year. And precisely we see that, for example, a great part of this is dealing with vehicles, within the cost of energy itself, the cost of other core goods, for example, in terms of hospitality, even food, for example, accounts for a big share of this cost of living increases. And this is going to have a very big impact on the way we talk about sustainability, at least in 2023. And we see that this transition towards new ways of generating energy, not only that may be, let's say, greener, or that do not have these same emissions as traditionally fuel-based or fossil fuel-based energies, but also that are accounting for the actual demand or the current demand that we may have in the future for in terms of energy. Another impact, or another mega trend that we have over here, is precisely active ownership and impact, and this is specific for the financial industry, where we do not longer see that the assets that we have as, for example, asset managers, asset owners, or any kind of other asset that we may be dealing with. It is no longer a matter of seeing that there is no responsibility of holding those assets, but actually investors are realizing that there is a possibility to influence others and to influence, for example, the companies that they are holding these shares from, or they're pretty much investing into, to move a little bit quicker towards this kind of sustainable investments. And ESG integration, meaning that considering the environmental, social, and governance factors into the wide investment process is usually this kind of preferred way of performing active ownership and not only just divesting, let's say, or investing only in the best performers of the industry, but actually trying to affect this change and trying to build it into this wider, let's say, way of considering sustainable investments. And finally, the last mega trend that I'm going to be talking about is precisely regulation, where there is, particularly after the last COP27, we are talking about this kind of collective action against greenwashing and how important is transparency and reporting from public companies. So the need for information is actually the base of these ESG strategies that we just talked about in terms of active ownership, but also is related to how quickly can, let's say, these companies and this private sector move towards facing the challenges that we are reaching from not only climate change or biodiversity, but also in terms of poverty or inequality or even corruption, for example, in terms of governance issues that may be affecting countries and so on. So this disclosure of information and disclosure of how we are doing things is, let's say, one of the first steps. But we are also seeing this regulation moving towards different taxonomies and requiring some, for example, pension funds or some credit institutions and so on to divest if they do not have, let's say, these ESG related screenings or ESG related strategies, not just screenings, but integrations into their own investment processes, right? So this is something that has been also keeping up with a greater pace and that we continue to be seeing within 2023. So I don't know if until this point we have any.
Hey, Isaac, I have a quick question. I'm not familiar with the term greenwashing. What does that mean?
Yes, greenwashing is, for example, when a company usually commits to, I don't know, net zero or even being less carbon intensive in terms of the emissions that they put up in the atmosphere and so on, but they just say it without really having an impact or a result that actually backs up that saying. Okay, so it is having these kind of commitments without having the results that they are expecting out of these commitments.
Okay, thank you. That's very clear.
Okay, perfect. So how can we pretty much be dealing with this from the perspective of the company? And we have a demo over here, and we have a possible way of talking about this that is going to be through the different enterprise risk management products and solutions that we currently have. There is this possibility to first apply the different scenario analysis that we have been talking about and these different mega trends and trying to figure out, well, in this first scenario, how would each mega trend play out and which opportunities and which risks, most importantly, can we face due to these specific mega trends? Right? So I'm going to leave you over here with this clip that actually mentions how this can be pretty much incorporated into Seahorse's products. So just give me a second.
Managing your ESG risks and indicators is easy using Seahorse. To see your risks, you first go to the risk module. Here you will see a familiar layout. In administration, you will manage all of your current methodologies as you are using them. In management, you'll be able to identify, assess, and treat your current risks. And in reports, you'll be able to see them visually. Let's go to management. Here, you'll be able to see your existing ESG risks. You'll be able from this screen to add a new risk. You can select an existing one or start typing out a new one. You'll be able to identify which class does it belong to, environmental, social, governance, the factors, link assets, existing controls, etc. You can also from this screen go to assessments and give this risk the specific inherent or residual assessment. You can also from the screen go and create an action plan and follow up on it. For example, this risk is that the banks is heavily relying on oil and gas, on the oil and gas industries. And here we want to create an action plan to diversify away from this, and we can follow up on this. We can also see this visually, our risk visually here in our heat map. In our heat matrix, you'll be able to see the inherent risks, go into the detail of each quadrant, and also figure out how you want to move from here to here. You'll be able to track also your indicators that you are following at the moment or create new ones. Once again, familiar layout, administration to handle your indicator methodology. You go into management to identify, assess, or treat. You'll be able to create new indicators from this screen or check out on an existing one. For example, this one is we want to decrease our total greenhouse gas emissions that we are financing through our portfolio of products. So we are tracking this, and I'm going to show you how this looks when we are creating our reports. Our ESG indicators, you can follow them here in the detail. You'll be able to see through the first 3 quarters of 2022. In the first one, we decreased on 20% quarter over quarter. This is for, remember, financed greenhouse emissions. 20% decrease along the first quarter, 15.25 on the second quarter, and 21 on the last quarter. We can make action plans, do the work, but this is how easily you can manage your risks and indicators using Seahorse.
Perfect. So what do I want to point out over here? That even though it might seem that we have to develop these kind of capabilities about thinking about the future and for incorporating these megatrends or these issues in the future, or for the possible impacts that we might have in the future about ESG issues. There are several tools that are actually currently available within enterprise risk management that can help us to cope with these kind of uncertainties, cope with these possible risks and even opportunities about the ESG megatrends. And there's also this possibility of just shifting the way that we traditionally manage risks, not only to account for what is happening right now or what has happened historically, but also of what could happen. And that is very, very relevant when we are, let's say, facing this kind of context, right? And that leads us to how to get and actually build these resilient decision-making processes. And for this, I want to let's say, consider that we are facing different environments and different contexts where 4 characteristics are pretty much defining what happens nowadays and what will happen in the future. First of all is volatility, meaning that the things and the ways that we pretty much identify data, or that we traditionally tend to see trends and so on, is shifting. And there might be, let's say, these different, let's say, data that may change very quickly, and that may not lead to, let's say, this short-term vision that we were even talking about previously. Then we have uncertainty, and we have discussed this uncertainty previously, but it pretty much says that we should be recognizing that we do not have control over all of the variables, and that we are going to be facing different levels of uncertainty to the distinctive ways or strategies that we are trying to perform. A third characteristic would be complexity, meaning that we should, let's say, avoid seeing that for example, the economic performance or the revenues that we have in the first place are just going to be, let's say, based on the capability that we have to, I don't know, cascade these objectives to different teams and so on, but that there's actually other systems that are going to be affecting this. And these are not only economic systems, but they can be social systems and environmental systems that we have to be dealing with, and that are going to be affecting the capability that we have to stand in the long term. And finally, ambiguity, that is going to be that from the data that we have and from the, let's say, capability that we have to understand what is happening. There might be not a clear, let's say, insight of what is happening. So this can be also linked to volatility, but from the data that we have, it might not be clear in the short term if we are on a bear market or if it is actually rising or being stable, or for example, or if there is this kind of I don't know, like if we do not have a particular performance in one quarter, and then it moves quickly to actually exceeding our expectations in the next one. This kind of ambiguous, let's say, data and context is also making very hard to make decisions. That is why we should be centered on these different possibilities and building the capabilities to track how much of each scenario are we pretty much facing, and which is the best way to adapt our strategies, not only considering that these strategies are going to be, let's say, static, and we have to pretty much like be very frontal in terms of following this strategy whatever it happens, but actually making them a lot much more resilient. So that is going to be one part and one capability that we should be discussing. And the other one is, on which stage can we find, let's say, the greater value to our organization based on the different stages of this megatrends adoption, and based also on the appetite that we may have on the risks that we're willing to take. Okay, because for example, these megatrends usually perform in this way. The blue line says, for example, how many of the participants in a market are actually adopting these megatrends and so on. So the innovators are going to be the, let's say, the minority of them in 2.5%. Then we have the early adopters, about 13%, early majority 34%, late majority 34% as well, and laggard 16%. So this is also the potential that we have to generate value. So if we are, let's say, these innovators, and we are like having this capability of incorporating these megatrends impacts on our organization since the very beginning, then we have the greater, let's say, space to generate value and over time. And if we are laggards, well, as much of the market is already, let's say, considering this or having this, then the difference from here to 100 is going to be minimal, right? So this is not, let's say, meaning that we all should be innovators and so on, but that we actually have to first identify which are the priorities to which we should be adopting this kind of mega trends according to the strategies that we have. And on the other side, that this should also be very adjusted to the risk profile that we have. So next steps and recommendations would be first to identify periodically these ESG risks and opportunities, and actually use these different scenario planning methodologies and these different capabilities that we have about the future in order to be dealing with them and managing them accordingly. The second point is to manage these ESG trends in volatile, uncertain, complex, and ambiguous environments through enterprise risk management systems. And finally, to decide optimal moment to incorporate trends within this organization according to the strategy that you're having and the risk that you're willing to take. So thank you very much. I don't know if there's any further questions.
I have one more question. I just want to make sure I heard you correctly, Isaac. And I love the presentation, a lot of good information. It seems to me, listening to this, that ERM presently has a lot of models that talk about probability of the future, what might occur at what rate. That seems a little finite to me. If I remember what I heard, and correct me if I'm wrong, what I heard a couple slides back was that we may need to start talking about a range of probable outcomes versus a singular probable outcome. And then when we discuss the range, that's where insight and foresight can actually play. So if I'm a chief auditor or a risk manager of a corporation, I may need to start changing my thinking to talk about and looking at probability completely different than what I'm used to looking, and talk about a range of results versus just one result. Is that a fair assessment?
Yeah, absolutely. So whenever we're talking about these probabilities and these scenarios particularly, we should be playing with this, let's say, wider range of probabilities according to the different uncertainties and the different variables that may affect the success that we may have in the long term. Because if we're focusing only on let's say, on a point in time, then that limits the opportunity of our vision, for example, to assess how strong or how well would the different strategies perform in the long term. Because if the, let's say, this specific set of assumptions do not work or move in a different way, then our probability, for example, of achieving that success is much lower than if we try to compare and see how well these strategies may perform in different scenarios and within different probabilities, and getting us a much more comprehensive view of what may happen in the future.
That's interesting, because that would imply then that models used in risk management are going to have to be expanded to include scenario probabilities, not just the probability of a fact. And ERM software is going to have to be able to allow us to track those scenarios, not just the independent contributors to those scenarios.
Yes, absolutely. And tracking those scenarios, and not only that, but also the link that they have to different impacts, or the link that they may have to these correction plans, is going to be key for long-term success.
Excellent, excellent. Thank you. Extremely important. I think that's actually a futuristic conversation we just had too. I like that.
Great. So thank you.
Thank you, Zach. I had a final question, and it is about when can a company adopt a mega trend according to the possible stages? And this, I wanted to get your perspective from a smaller institution, a smaller and local institution, right? We've seen things in your presentation that are especially important for this kind of companies.
Yeah, absolutely. And I would say that it depends on the risk profile, absolutely, because being a small organization can mean different things. That some of them can have an advantage in terms of being much more innovative, or trying to push forward for this kind of trends, and on the other side, for example, to being much more, let's say, risk averse, and trying to be much more conservative in the early stages. So it actually depends a lot on the vision that they have about this issue, and also the risk appetite that they may have. So I suggest that this cannot be interpreted without this risk assessment framework. Great.
Thank you very much, Isaac. I think this content is of great value to our listeners, and especially companies in those smaller asset classes and local perspectives. Thank you very much.
Perfect. Thank you so much, and have a great day.
Thank you, Dan. Thank you, Isaac.
Thank you.
Bye bye.
See you. Bye.